Yeah, as long as these companies don't go right out of business, but like some of these, like Husky here, trading at $3. You know, when oil moves back up into the 40s and 50s, it would recover probably to the $20 area pretty quick. So, I mean, that's 6 times, 7 times gain possibly, right? So that's kind of it for the oil. Like I say, I'm not doing anything in that field. I don't own anything in that field right now. There is an index for the frackers, to buy the whole frackers, but we can see that too has just been a bad investment unless you're shorting it. But I mean, it dropped from $9 right down to $4 in quite literally a couple trading days. So there's going to be lots of blood in the streets before this is over. So so that's it for the oil. What else I got here? I want to talk a little bit about the market technicals. I did do a little bit of buying today, not very much. Let's see here. Yeah, so economics. Like I was mentioning the speed of this too. Like moved from an all-time high to a bear market in roughly 19 trading sessions. And normally to go to a bear market for a 20% correction, it would take 136 days. So I'm really thankful that, or somewhat lucky that I did get out. I've been, like I said, almost 97% cash before this really started to break down, and I was 40% cash at the beginning of February. And I built short positions that haven't worked as well as what I've thought, but they should work. A lot of it's because the volatility's gone up so much. But once the volatility falls, a lot of the options should be that I wrote down, I think in 2 or 3 videos ago. They're all listed there. I still have all those, but most of them now are safely below my strike price. And most of them come up over the next couple of months. I think, you know, July, August is the latest I went out. So that they should all eventually work out, because I don't see the market really coming back anytime soon. I'm sure we're gonna, like today, Friday, we're having an update because it's kind of a concerted global effort now to inject money into the economies around the world. But I just don't think this is going to do too much. You can't force people to go out and spend money. People are quarantined. You know, they can't get into work. It's more of it's more of a demand problem now than a supply problem. So we'll just have to see how it goes. I'm not really making any predictions because it's just I don't think anybody really can. But my feeling is that we will end up with at least a 30 plus correction by the time this is all over. So the economic data again keeps coming in. Sales in Japan for last month, car sales were down 79–80%. I mean, these kind of numbers we just haven't seen in modern times. And bond yields have been swinging up and down, so there's lots of uncertainty in the bond market. Again, we're seeing junk bond index has dropped a lot, and I think we're going to see a spread between the different rated bonds increase. And there's been a lot on the repo market. I don't fully understand it, but it's basically what the banks lend each other overnight. And this number, we've been seeing the Fed have to intervene, and you know, sometimes $70 billion, $130 billion, just to keep the liquidity there. So it's if a lot of the banks, again, don't trust the other banks, so then they have to go to the Fed if they need some cash. This happened back in 2009. Yesterday, they put think it was $1.5 trillion into the, injected into the financial system, the Fed did. So again, I've talked a lot about this in the past, how they just keep kind of printing this money, and I think eventually it's going to have an impact on what a dollar is actually worth, or we could see more financial asset inflation, maybe now in real estate. There's a stock market and bond market, but eventually if we get a bad recession and jobs aren't there, then real estate's not going to hold up either. So that's just something else to watch. So again, most of my things that I look at, I won't go through them all here, but they're still bearish. And one thing I've talked about is the 12-month, I think just in the previous video, was the 12-month rate of change. And I said it hadn't crossed the zero line yet. This one has been very, very good at predicting a bottom in a market once it goes to -20 and then turns around and comes back above -20. That's usually a pretty good buy signal. And last bull market, if you would have used that to buy, you would have captured probably about 80% of the gains. So we can see here we're at almost -10, and we'll just have to see what happens with that. But you can see back in 2009, got below -20, came back about -20, and right here, so all this whole period here, you could have been long, right? And then I ignored it does drop below the zero line a few times, but at the beginning of a bull market, I typically ignore it. That's kind of noise. But at the end, I start paying more attention to it. So that was what we can see here too. The amount that we've dropped, in 2009, we can easily drop another 1,000 points. Actually, would be about 1,100 points or so. Would just get us back to the I've got a line I drew here from the 1975 trend line. 1973, 1974, the markets dropped 50%, and then they kind of went into kind of a long bull. And that line there is down, way down at 1,300. And these purple lines just measure the drop from 2009. So we can see we're in such an unknown right now that I think this we could easily see another 4 or 5, maybe 1,000 points down on the S&P. Of course, it's not going to go straight down, but I think think for sure that we'll definitely see new lows. So this, again, this is the moving average. A lot of people follow the 200-day moving average, which is the bluish line here. You can see if stocks stay below the 200-day moving average, it's kind of a good trend day. And we've crashed right through the 60, and we crashed through the 200. And again, but a positive signal is when these two cross. So when the 60-day crosses over the 200, that's a good buying signal. And you can see here that would have captured nearly all the gain if you would have stayed in from that cross here, which you can see here. So ideally we want to see the 60-day come down, cross over the 200, and then come back up. But going by the 60, it's been so rapid here that the 60-day hasn't really moved as much as it probably should. So again, that's another thing I'll be watching closely. But by this, I think we're still in the early days of the correction. What else do we got here? Secular bull. So the other thing has been the VIX, which is a volatility index, and it's reaching again almost all-time highs. We got here. So we can see the VIX back in the 2009 financial collapse almost hit 80, and we've had a few little jumps along the way with comparative sell-offs here, but normally when the VIX gets up above 40 or so, usually the stock prices come down. Very good correlation between the two, and we can see now we're up at 70. Another reason I don't want to be buying right now, I want to see the VIX come down into the be trending down is a big thing. As we can see, it did actually back in 2009. It trended down for almost like 2 years. So you can just kind of follow the trend, and when it gets to 30 or 20, start putting some money back to work. So again, that's right now just way too risky, way too unpredictable to really be buying too much. So I'll be keeping an eye on that. So that's the VIX mentioned. So I mentioned, I did buy, again I've just been saying that I haven't, I think the market's going lower, but I am finding some stocks that are just, to me, trading, you know, they've had 4 or 5, 6 years knocked off them, and I still kind of need a bit of a dividend income and want to look for opportunities to eventually rebuild my dividend portfolio. So I bought Bell Canada today, just a very small amount. I expect a lot of these could go lower, but it's just a matter of kind of inching in, and it's a lot easier than